Ottawa has responded with a 50% tariff. US President Donald Trump's steel and aluminum tariffs are striking at the heart of North America's largest supply chain. Canada's retaliatory decision could instantly make the automotive and beverage container supply chain stretching from Detroit to Vancouver more expensive. If Washington does not back down, the industrial heartlands of both countries could fall into a shared recessionary rhythm. Will Carney's tough stance weaken the US-Canada alliance or force Washington back to the negotiating table? We will examine the details of the latest developments around the world. Don't forget to subscribe to our channel, turn on notifications, and like our videos to stay up to date with our content. The security-level cabinet meeting held at the Rideau wing of the Prime Minister's office at the end of June took place on a typical Friday afternoon, with Ottawa journalists expecting a modest press release under the headline, Energy Transition Plan. However, as soon as the meeting ended, a single sentence leaked to the press sent both Bay Street stockbrokers and K Street lobbyists into alarm. Carney has given the Treasury and Trade Secretaries full authority to prepare for retaliation against President Trump's steel and aluminum tariffs. Just a few hours later, Reuters, Bloomberg, and Yahoo Finance confirmed the first details of the plan. Canada was planning to impose heavy tariffs on approximately $22 billion worth of US-sourced semi-finished metal imports annually, with a 50% cap under a temporary regulation to be announced in mid-July. Trump's decision in March marked the harshest move since the North American Free Trade Agreement was established. The US began imposing a 50% tariff on Canadian-origin hot-rolled steel, aluminum profiles, and raw materials for pressurized beverage cans, defending the move on national security grounds under Section 232. Leaked internal memos from White House advisors revealed that Washington's primary goal was to prevent Chinese-origin steel from entering the US, market through origin switching via Canada, to enter the US market. However, the Carney administration dismissed this defense as protectionism, based on flawed data sets, ignoring the real carbon footprint and punishing supply chains within the same alliance bloc. Ottawa's initial response was cautious. In April, the federal cabinet announced a CAD $3.5 billion buffer fund under the name of Industry Transition Credits, providing zero-interest cash flow to key producers such as Stelco, Algoma, Rio Tinto Alcan, and ArcelorMittal Dofasco. However, by the end of June, the buffer was insufficient. The US 50% tariff had made Canadian-origin hot-rolled coil $308 per ton more expensive than the spot price of Chicago futures contracts. In Alberta, oil pipeline construction, an Ontario automotive chassis supplier, and an aluminum beverage compress line in British Columbia began piling into Bank of Montreal loans due to urgent cash demands caused by rising inventory costs. Mark Carney's intention did not seem to be limited to paralyzing metal with a double tax. Between the lines of his statement, there was a sense of desire to redefine the cross-border supply chain, which had long been considered untouchable in North America. Sources close to Carney reported that the Prime Minister had been obsessed with data since his days at the Bank of England, giving his officials 48 hours to gather details such as steel casting locations, hot furnace chemistry certificates, and carbon isotope analysis. In other words, Ottawa was preparing to dismantle Washington's national security argument by measuring where steel was cast, what scrap it was made from, and even its carbon emissions profile. However, Carney did not hesitate to use the same file as a pretext for retaliation, saying, "The carbon footprint of American-made steel pipes is also high, while our production is cleaner, so passing on the cost to consumers is the US's problem." Where did the idea of a 50% tariff come from? According to sources familiar with internal documents from the Canadian Ministry of Finance, Minister Chrystia Freeland commissioned a shock simulation at the end of April. The scenario was as follows. If Canada raises import taxes to 50%, US-made raw steel coils would increase by at least 420 CAD per ton, resulting in an average cost increase of 850 CAD per pickup truck and SUV in the Detroit-Toronto automotive corridor. The simulation's striking finding was that most of this cost would be passed on to consumers by automakers, meaning that it would be the profit margin of vehicles produced in the US and sold in Canada, rather than Canadian consumers, who would bear the brunt of the blow. In other words, Carney aimed to respond to Washington's national security claim with a multiple response in terms of consumer welfare. The counter-tariff move caused fluctuations not only in bilateral trade, but also on the London Metal Exchange. Cold-rolled steel futures contracts on the LME rose by 60 cents per ton in a week following the announcement of Canada's retaliatory measures. Aluminum 3-month futures contracts surpassed the 2,540 Marimati threshold, reaching an 8-month high. Morgan Stanley interpreted this price reaction as the return of supply security concerns to the market for the first time in 6 months. This is because, despite its seemingly small market share, Canada was a key supplier of low-carbon aluminum ingots powered by clean electricity in North America. Canadian ingots played a critical role in the carbon footprint reports of U.S. NEA, New England region beer, manufacturers and automotive players like Tesla. If the tariff disrupts this flow, carbon compliance costs will rise, potentially leading to unexpected shortfalls in IRA tax credit calculation tables. The impact assessment prepared by the Canada Border Services Agency, CBSA, painted an even bleaker picture. In a scenario where the US cannot access Canadian aluminum, it would likely purchase castings from Australia or Gulf countries. This route has both high transportation emissions and long supply times, which would worsen the US's carbon balance. In short, Carney was forcing Washington to confront not only a commercial but also an environmental superiority argument as a bargaining chip through retaliation. Ottawa's plan is not just to impose taxes, but to support the sector with a domestic resource enhancement package at the same time. A draft leaked to the press at the end of June includes a CAD $4.8 billion Green Steel Accord fund backed by a credit guarantee from the Royal Bank of Canada. The fund will be distributed in the form of tax credits, capital grants, and low-interest loans to investments such as the conversion of ArcelorMittal Dofasco's electric arc furnace, EAF, in Hamilton, Algoma's Hydrogen Direct Reduced Iron, HDRI, pilot line in Sault Ste. Marie, and the inert anode project at Rio Tinto Alouette's smelter in Quebec. In other words, Carney is pursuing a strategy of, if the American tariff wall is going to hit in the short term, let's use that time to invest in low-carbon capacity. While Trump's economic team dismissed the move as a financial technocratic maneuver, some Republican lawmakers on Capitol Hill began sounding alarm bells. Wisconsin Senator Bill Hagerty said in a statement, "Canada is our #1 agricultural, energy, and metal partner. If we enter a cycle of retaliation, the White House may gain short-term political points. But in Detroit, it won't just be the unions rising up, it will be the CEOs as well." Indeed, Ford and General Motors noted in internal reports that a 50% tariff on thick steel plates imported from Canada would erode the net profit margin of vehicles by $320. This translates to a profit loss of $45 million over the lifetime of a model. The International Institute of Finance, IIF, report titled North American Trade Tensions, published at the end of June, calculated that if the tariff war on steel and aluminum trade between the US and Canada continues, the total GDP growth of both countries could decline by 0.3 percentage points by 2026. While this figure may seem small for the US economy, it represents another blow to a financial system already burdened by rising interest rates due to Trump's stimulus-driven inflation. Canada, on the other hand, can partially cushion the impact through its energy export surplus and weak currency. However, the IIF forecasts that retaliation risks could shave 0.4 percentage points off Canada's growth through the net export channel. Carney's political engineering is based on securing support from the NDP and Bloc Québécois in the federal parliament. Conservative leader Pierre Poilievre criticized the Prime Minister for shaking the foundations of the beaver economy by responding to protectionism with protectionism. But public opinion polls paint a different picture. In the latest Abacus data poll, 61% of voters say equivalent retaliation should be taken against US tariffs. This figure rises to 68% in Ontario's industrial belt. In other words, Carney's counter-tariff plan is popular domestically. Nevertheless, Ottawa needs to pursue a dual objective: responding to Trump's tariffs and protecting steel and aluminum producers while simultaneously demonstrating to global supply chains that Canada will not lose its image as a stable haven. To resolve this contradiction, the Prime Minister's Office of Economic Affairs signaled the tariff ladder formula on the sidelines of the G7 finance meeting in London. According to the draft, Canada will announce a 50% cap, but will show in a transparent table that the rate will be gradually reduced every 3 months if the US minimizes its 232 tariffs. In other words, Carney will keep the pressure on, but will offer a clear roadmap for backing down. The issue of international enforceability is also critical. In 2018, the Trudeau government responded to Trump's steel tariffs with a 25% tax, which was lifted at the same pace once the USMCA negotiations were concluded. This time, Carney is emphasizing that the takeaway game has eroded trust and that new retaliatory measures must be prepared with a solid justification that could be taken not only to the US, but also to the World Trade Organization's dispute settlement panel. CBSA lawyers confirmed that they had prepared a draft DSU complaint alleging that the US was misusing Section 232 on national security. The lawsuit will be filed in Geneva once the tariff decision is announced. Meanwhile, Canada's tit-for-tat plan is being closely watched in Tokyo, Seoul, and Canberra. This is because the US has tried to balance similar 232 tariffs against South Korea and Japan with quotas, while exempting Australia. If Ottawa's 50% retaliation is successful, these countries may play the "we can respond symmetrically" card. Especially in Japan, where raw material imports are expensive and automotive exports are significant, US tariffs threaten both production and refinery investments. The question of whether Canada will extend the tariff to automotive, agricultural, or technology supplies is not on the table for now. Carney's advisors say the strategic focus is on steel and aluminum. However, if Washington expands further, the range of responses could be broadened. The Prime Minister is careful not to openly play the energy export card, as 69% of Western Canada's crude oil still goes to US refineries, and the billions of dollars in swap agreements dependent on this flow sustain the country's public finances. On the industry side, the coalition of support is broad. Marty Warren, president of the United Steelworkers Canada, said, "Trump's tariffs are a betrayal of workers. Carney's move is late but right." The Quebec Aluminum Association welcomed the aluminum shield, as the collapse of margins on raw block sales to the US had resulted in a loss of CAD $280 million in revenue in 1 year. In contrast, some importing sectors are raising their voices in warning. The Brewers Association of Canada argues that a 5-cent increase in aluminum prices could be the last straw for the craft beer sector, causing small boutique producers to lose shelf space. Carney is trying to convince high-volume beverage producers such as Danone, Coca-Cola, and Molson to accept partial tax exemptions based on historical quotas to reduce the risk of a price shock. The foreign press is reporting these behind-the-scenes talks as Carney's broad coalition diplomacy. The possibility of the steel and aluminum tariffs being withdrawn in the US remains uncertain for now. In an election year, Trump wants to strengthen his pledge of a protective shield for steel workers in Rust Belt states such as Pennsylvania and Ohio. However, most of the facilities in question use Canadian raw materials, not Chinese ones. If the retaliation cycle continues, a boomerang effect will be felt in the value chain. The American Iron and Steel Institute, AISI, predicted in a report published at the end of June that if the flow of raw steel from Canada is disrupted, the capacity utilization rate of US domestic solid fuel blast furnaces will fall by 4 points, which would mean the loss of 4,200 jobs in Ohio and 3,600 jobs in Pennsylvania. So, ahead of the November elections, Trump faces a risky dilemma with his own voter base. Protectionism feeds the idea of a border wall in the short term, but it could trigger unemployment and sway voter preferences. The repercussions in the high-tech arena should not be overlooked either. Tesla plans to source aluminum from Canada for its Berlin cell factory, but the tax war will increase supply costs. If the company turns to lower-quality aluminum from Indonesia for its super presses in Nevada, carbon content will rise, and access to cheap financing will be put at risk. Additionally, SpaceX Starship body alloys rely on Alcoa Montreal cast blocks. Retaliatory measures will drive up the price of high-wear-resistant aluminum-lithium alloys, causing fluctuations in space project budgets. The World Trade Organization's role as an arbitrator in global trade is becoming increasingly difficult. The current appeals body remains gridlocked. Delays in DSU rulings are occurring because the US has blocked many judges who are geographically dominant. Carney's complaint to the WTO will likely sit on the shelves for years, leaving the issue to be decided during a period of political preference. Ottawa will try to achieve results and force Washington to back down with a counter-tariff plus investment incentives plus diplomatic pressure triangle in the face of legal deadlock. From a geopolitical perspective, the Canada-US metal tension does not leave China merely as a spectator. Beijing assesses that the contradictions within the Western Bloc are self-defeating. This benefits our ultimate market share. In fact, the Chinese Ministry of Commerce is expanding its steel export channel to Central Asia through the Eurasian Economic Union, aiming to redirect its excess blast furnace capacity to European demand through Kazakhstan. If Carney's retaliation pushes the US further inward, China's indirect export margin could strengthen. Ultimately, the Canadian Prime Minister's plan to paralyze the US with a 50% tariff is not just a tariff technique. It is a multi-pronged strategy package extending to energy climate policy, industrial investment, and election calculations. Its success or failure will shape the future of North America's economic architecture for the next decade, as steel and aluminum form the backbone of $836 billion in trade between the two countries. Carney believes that Washington can only curb Trump's escalation with a symmetrical response based on data, legal grounds, and domestic coalition support. Trump, meanwhile, is hoping that his America First slogan will resonate again at the ballot box. What are your thoughts on this matter? Please share your opinions in the comments section. To stay updated on new videos, please subscribe to our channel and turn on notifications. Thank you for watching.